arrojar un poquito de luz a estas previsiones, vamos a ampliar la información y lo vamos a hacer con la ayuda del precisamente jefe de división del Departamento de Estudios del Fondo Monetario Internacional, Malhar Nabar. Muy buenas tardes, Malhar. Thank you for attending us. Good morning for you.
Thank you for having me.
So the IMF is thinking that there are more growth potential for the global economy this year and the next one, even despite the strong uncertainty and the risks. So why is that? Why is the IMF revising upwards their forecast?
Yes, even with this high uncertainty, we have revised up our forecast relative to the previous projections, mainly because of additional policy support that we've seen in a few large economies, for example, in the United States. The rollout of vaccines and the expectation that the vaccine-powered normalization, especially for contact-intensive activity, will take place later in this year is another factor behind this upgrade.
But this recovery will be uneven, will be different between countries and regions and even within their own countries. So what will be the consequences of that?
Yes, there is an expectation of divergences within countries. Different demographic groups have been affected to different extents. Low-skilled workers, workers with lower education attainment, the youth, they have been hit far worse in this crisis so far, and we expect that could be a force for increasing inequality within countries. Across countries, we see the advanced economies in particular were able to deliver sizable policy support last year. They're also the economies that have been able to procure more vaccine doses, and therefore they're expected to go through faster recoveries than the emerging market and developing economies. But even within those two groups, the advanced economies and the emerging market developing economies, we see divergences based on country circumstances. So the divergences across regions, across countries, within countries, there's a lot of multi-speed recovery taking place at the moment.
And in this context, which countries will emerge stronger? Because we've talked a lot about China's recovery, and we've talked a lot about United States recovery and the Joe Biden's stimulus plans. So are we talking about these countries as the winners, or are we talking about other countries?
Yeah, these are two of the more prominent examples. Of course, China last year, it had a very effective containment effort very early on, and then provided a lot of support, mainly through infrastructure investment. And that enabled the economy to actually achieve positive growth last year, which was one of the few economies that registered positive growth in 2020. The United States has had 3 rounds of support packages through to the American Rescue Plan that we saw just last month. All of these efforts are, of course, helping to put the U.S. economy back on the recovery path, and it is expected to regain its pre-pandemic level of activity already by the first half of this year.
Mm-hmm. I will ask you as well about the unintended consequences, because the report says or talk about the risk that accelerating growth in the U.S. could lead to a rapid rise in interest rates. This could lead to a sharp tightening of financial conditions and significant capital outflows from emerging and developing countries. Could you tell us a little more about it?
Well, it's important to keep in mind that when we have these divergent recoveries, there's a prospect of divergent policy stances with the economies that are further ahead in the recovery looking to begin the normalization process for their policy stance. And in this context, the speed at which interest rates go up is a big factor that could affect prospects especially for emerging market and developing economies. So we've already seen since the start of this year, interest rates in the United States, long-term interest rates, the 10-year yield going up very quickly, and that has lifted interest rates in many other countries as well as a result. And in a situation of this kind, vulnerable emerging market economies could face difficulties if this were to persist. But it's important to distinguish between interest rate increases that happen in the context of favorable news on growth, such as we're seeing right now, where growth prospects for the US economy have also been upgraded significantly, and that's accompanied by this increase in interest rates. It's important to distinguish that mix from a mix where you have very rapid increases in the interest rates, but growth prospects are not upgraded in a commensurate way. So it's a second category of interest rate increases. If they happen very rapidly, if they're not accompanied by improvements to the growth outlook, those are the types of interest rate increases that typically pose difficulties for emerging market and developing economies that have borrowed heavily in foreign currency and that have limited trade links to the advanced economies.
Mm-hmm. Okay, it's clear. So the report talks as well about how important it is to maintain measures to help households and businesses remain viable. In which way?
Yes, so we've seen a lot of innovation on the policy front in many countries over the past year with expanded job retention schemes. For example, in Europe, you've seen a lot of these measures being implemented. There's been a lot of support through transfers to affected households, to affected firms. But going forward, the longer this pandemic lasts, it's important to make sure that these measures are well targeted to those that are worst affected through this health crisis. And as the pandemic is beaten back, as labor market conditions start normalizing, it's important to shift the emphasis away from job retention schemes, from income support schemes to reallocation, to incentivize hiring through hiring credits, for example, through full tax expensing of depreciable assets that tends to incentivize investment. This shift in emphasis can help hasten the labor market recovery and allow the economy to have the sort of reallocation that might be needed coming out of this pandemic and to have a durable recovery going forward.
Mm-hmm. And how to balance all these measures with the financial stability, because we're acting right now different if we compare it with the previous crisis, but we have to keep that in mind as well.
Absolutely, that's a very, very important point. In fact, what we've seen so far is because of the extraordinary measures that were taken, not just on the fiscal policy front, but also with financial regulatory policy, monetary policy. There's been innovation on the monetary policy front as well. In Europe, for example, you've seen the new pandemic purchase facility, which the envelope of that facility has been expanded. And we've seen a lot of effort through these extraordinary measures to prevent an amplification of this crisis, to ensure that you don't have a wave of bankruptcies, that this does not morph into a systemic financial crisis. Going forward, as these emergency measures are scaled back, it's important to do this in a way that does not lead to an abrupt tightening of financial conditions. It's important to prepare insolvency and bankruptcy frameworks to deal with possible firm failures going forward. All of this is extremely vital to limit persistent damage from this pandemic and to ensure that all economies get back on paths of durable recovery.
And what about the central bank policies? Because we're talking here as well about important stimulus plans, but we have to keep in mind as well how to avoid episodes as the taper tantrum in 2013.
Yes, absolutely. The communication, very clear communication on the outlook for monetary policy, what the reaction will be of the central bank under different developments, economic developments. All of this is key to ensuring that we don't have very abrupt repricing of risk assets. We don't have a very abrupt increase in interest rates of the kind that we saw in 2013. And with this very clear, effective communication on the outlook for monetary policy, that will also allow emerging market and developing economies some more breathing space in terms of giving them time to prepare for the eventual normalization of policy once advanced economy central banks feel that they have to start normalizing their policy to be consistent with their price stability mandates. So communication, clear communication on the outlook is absolutely key through this potentially difficult period ahead.
And how do you see the European economy and the role of the European funds?
The European euro area economy, as you know, went through a very deep contraction last year. We are expecting growth to rebound this year to about 4.4%. This is a strong recovery. It reflects in part the very strong measures that were put in place last year through the job retention schemes, through the efforts that the ECB took with the expanding its asset purchase facilities and with the new facility that we just talked about. All of these efforts have helped put the the European economies back on a recovery path. And we've also seen a willingness to adjust the fiscal policy stance as news about the pandemic came in. We've seen more support being delivered to help affected workers and households and firms get through this very difficult time. The innovations that have taken place at the European level, for example, with the next generation EU funds, are going to be critical also for supporting the recovery going forward, as more of the projects that are financed through the next generation EU funds start coming online and start delivering the recovery that we expect going forward. So it's absolutely important to make sure that the funds are deployed effectively and in a relatively quick fashion to help support the recovery.
Mm-hmm. And finally, I have to ask you about Spain, as expected. So you have raised the forecast for the Spanish economy. You see a 6.4% for this year, and you're maintaining the forecast for the next year. How do you see the Spanish economy? Because we had a really bad 2020 as well. So what are the main challenges and vulnerabilities?
So the Spanish economy did, as you mentioned, go through one of the worst contractions that we've seen, both in terms of Spain's own history, but also if you look at the advanced economies, it suffered one of the deepest contractions, reflecting the structure of the economy, the reliance on the prevalence of small and medium enterprises, the reliance on tourism. All of these factors made the Spanish economy more vulnerable than some of its peers when faced with this unprecedented shock. Going forward, we do expect Spain to get back on the path of recovery this year, with growth projected above 6% for this year. As is the case with a lot of other countries that are in similar situations, it's important to ensure the first priority, of course, is to beat back the health crisis, to ensure that health spending is protected and there's adequate funding for the healthcare system. And at the same time, to also ensure that the fiscal policy that's been put in place is well targeted to those that are most affected. The job retention schemes, for example, to ensure that those are going to the sectors that are worst affected, while also looking ahead to perhaps putting more emphasis on hiring subsidies, on incentivizing job creation as the recovery takes hold. With this flexible policy approach, shifting away from retention towards reallocation as the labor market gets back on a stronger footing, we think that this will help provide the kind of impetus that's needed to put Spain on a path of durable recovery going forward.
So there's a lot of work going on. So, Malhar Nabar, Jefe de División del Departamento de Estudios del Fondo Monetario Internacional, muchísimas gracias. Thank you so much and have a nice day.
Thank you for having me.
Bueno, pues ahí teníamos esa entrevista con el Jefe de División del Departamento